Hello. In this video, we're going to go through some examples when there's changes in estimates and how to account for them prospectively. This is the second video from the changes in estimate, so some of this will be a repeat. But when we have some accounting changes, depending on what the changes are, there are different approaches as to how they should be recorded in the financial statements and on the general ledger. We've discussed retrospective approach in previous videos, and that'll be for the change in accounting principle plus change in reporting entities and a correction of error. Correction of error, which is when you have to restate all your prior year financial statements. When you have a change in estimate, thankfully, the accounting is not as complicated because all you do is you reflect the change in the current statement and future statements, but you don't change anything prior to that, and you don't have to restate anything prior to that either. Some examples of estimates that are made in accounting is we estimate how much accounts receivable we're not going to collect, and we book a bad debt expense and allowance for bad debt for that. We also estimate how much inventory is not going to be sold due to either it's not sold, it's spoiled, it's stolen, whatever it is. We estimate the useful lives of our assets and the salvage values. We might estimate the warranty costs for our products that we sold. And we sometimes, even though this is not an estimate really, it's when we change depreciation method, it's considered to be a change in estimate that is achieved by a change in accounting principle. So we still treat it as a change in estimate. So let's go through some examples for change in accounting estimate and how they should be recorded in the journal ledger. Universal Semiconductors estimates warranty expense as 2% of sales. After review during 2027, Universal determined that 3% of sales is a more realistic estimate of its payment experience. Sales in 2027 are $400 million. The effective income tax rate is 25%. No account balances are adjusted. So because we just have a change of estimate of our warranty from 2% to 3% of our sales, we don't change any of our prior period accounts or any sort of prior period presentation on the financial statements, but just instead in 2027, we would book the following entry. We would debit warranty expense and warranty liability for the sales in 2027, multiplied by our new revised estimate that we think we should book, which is the 3%. So we book debit 12 million, credit 12 million for those accounts. Typically, no disclosure is needed if you have a change in estimate, except if that change is considered to be material. And a material amount is not a set amount for every company. It can also change year to year. It's just what amount that makes this change would influence the reader of the financial statements to make a different decision, then it has to be disclosed. That's what we mean when it says it only needs to be disclosed if it's a material amount. So when we do need to disclose it, we have to disclose the after-tax effect, okay? So when we do that, let's just say we have to disclose the difference in the estimate. So we would take our $400 million, multiply our difference in estimate went from 3%, from 2% to 3%. So that's the 1%. So we have more warranty expense of $4 million than we would have using the 2%. And then you have to tax affected because if you have more expense, then your tax expense will be reduced, right? So you have less tax benefit. So you have to, which is 1% because our tax rate is 25%. So our net benefit when we take this change will be an additional $3 million. So if this was considered material for this company, there would need to be a disclosure, and something to the effect of, in 2027, the company revised the percentage used to estimate warranty expense. The change provides a better indication of its actual experience. The effect of the change was to decrease 2027 net income by $3 million or 3 cents per share, assuming that they had 100 million outstanding shares of common stock. Okay, so you have to disclose what the effect is to the net income, which means you have to take the tax effect into consideration, and you have to disclose the earnings per share amount, the effect that it has on earnings per share. Let's take an example of a change in depreciation method. Universal Semiconductor switched from double declining balance depreciation method to straight line depreciation method. So remember, even though this is a change in accounting principle, we treat it as a change in estimate. The change affects its precision equipment purchased at the beginning of 2025 at a cost of $60 million. The machinery has an expected useful life of 5 years and an estimated residual value of $3 million. So prior to the change, right, using just the double declining depreciation method, the problem tells us that our 2025 depreciation was 24 million, 2026 depreciation 14.4. So our accumulated depreciation as of 12/31/2026 is $38.4 million. And then in beginning of 2027, they switched to straight line. So let's see how this is done. Okay, here's our original cost of 60 million. We have accumulated depreciation to date of 38.4. So our undepreciated cost, or also you can also call this the net book value at 1/1/27, is 21.6. Now you have to reduce that by the estimated residual value, which gives us to 18.6, and the life of this asset is 5 years. It's already been depreciated 2 years, right, in 2025 and 2026. So there's 3 years remaining to depreciate it. So you take the 18.6 divided by 3, and now your new depreciation for the next 3 years is going to be $6.2 million per year. And the way we record it is just like the way we always record depreciation expense. We would debit depreciation expense for 6.2 million and accumulate depreciation for $6.2 million for each of those years from 2027 through 2029. And here's just another example of what the disclosure could look like if this was considered to be a material change. Let's do a concept check. Lamont Communications has amortized a patent on a straight line basis since it was acquired at the beginning of 2024 at a cost of $50 million. During 2027, management decided that the benefits from the patent would be received over a total period of 8 years rather than the 20-year legal life being used to amortize the cost. Lamont's 2027 financial statements should include one of these. Okay, let's go through the problem step by step. First, it told us that it was acquired in the beginning of 2024, and at that time, they used a 20-year life, and the cost was $50 million. So we would take 50 million divided by 20, and starting in 2024, they had amortization expense per year of $2.5 million. Okay, now I'm just taking that table and bumping it up so I can build on it within the slide. So if I had amortization expense of $2.5 million per year, then my net book value on 1/1/27 would be $50 million cost, less my accumulated depreciation of $7.5 million, and that consists of the $2.5 million per year for 2024, 25, and 2026. So that gives me 7.5. So my net book value on January 1, 2027 is $42.5 million. And now I have to they revised the life of the patent to 8 years. So how do we account for that? We're going to take our net book value on 1/1/27 and divide it by the remaining useful life that this patent has. The revised life was 8 years, but we've already amortized it 3 years, right? We've already amortized in 2024, 25, and 26. So it has a remaining useful life of 5 years. So I'm going to take my book value on 1/1/27, divide it by my remaining life of 5 years, which gives me a new amortization expense to record for $8.5 million. So I would record this $8.5 million every year for the next 5 years, and I would record a debit amortization expense for $8.5 million, credit accumulated amortization for $8.5 million for the next 5 years. So let's go on, because that's not the problem's not asking you how to record it. The problem was asking for what's the net book value at the end of 2027, which means I take my original cost less my accumulated depreciation through the end of 2027, which is $16 million. That $16 million is made up of the $7.5 million for the first 3 years, plus now the 2027 year that I take my amortization expense of $8.5 million. So that's how I get this $16 million accumulated depreciation, accumulated amortization. So my net book value at the end of 2027 is $34 million. So the question says, Lamont's 2027 financial statements should include what? And it's going to be D. It's the patent balance of $34 million. When it says the patent balance, it means the net book value. That's the balance. But notice here, it could also ask you, you have to read the question carefully. It could ask you different things. It could ask you, what's the patent amortization expense, for 2027. It could have asked you, what's the net book value on 1/1/27. It could have asked you so many different questions. So always pay attention to what the question is actually asking you.